Hi, I'm Bernanke, and today I'm going to be talking to you about money, banks, and the Federal Reserve. Once upon a time, there lived a farmer named Bingo. Bingo decided that he needed to have another cow on his farm, so he decided to ask the neighbor if he could trade his chicken for a cow. His neighbor laughed at the one-legged chicken and denied the trade. In order for a barter trade to take place, each party must want what the other person has. These bartering issues gave society a reason to come up with something that everyone would accept: money. Whether using commodity money, like food or gold, or paper money, they need to serve the following three purposes. First, medium of exchange, which is when sellers accept money in exchange for a good or service. 2. Unit of account, meaning giving money a measuring value. 3. Store value. Money, or commodity money, must also have these 5 characteristics. It must be accepted by most people, should be standardized quality, should be durable to store value, should be valuable relative to weight and portable, and it should be divisible. Commodity money often falls short of one or all of these characteristics, whether it be cumbersome to carry or divide, or it may lack universal quality or acceptance. Therefore, we use fiat money, which is money that has no other purpose but to be used only as money. Our paper currency is now issued by a central bank, which is an agency of the government that plays a role in our money supply. The money supply consists of both currency and checking account deposits. The way banks create money is through accepting deposits and making loans, which creates checking account deposits. Banks are required by law to keep 10% of checking account deposits in reserves. On a bank's balance sheet and/or T-chart, a loan is considered an asset because the loanee must make payments to the bank on their loan. Also, a deposit is considered a liability because the bank owes that money to the household or firm who's deposited. Money, it's a gas. Grab that cash with both hands and make a stash. You can't count the all-star daydream, think about me, football team. To calculate the total increase in checking account deposits from an initial deposit, we use the simple deposit multiplier, which is change in bank reserves times 1 over RR, or the reserve ratio, equals change in checking account deposits. There are 3 ways for a central bank to manage its money supply. First is open market operations, which is a committee of 12 members that meet 8 times a year who are in charge of buying and selling treasury securities. Second is the discount policy. If the Fed decides to lower the discount rate on loans made to banks, reserves increase, thus making it possible to loan out more money to households and firms. Third is the reserve requirements. The Fed may reduce or increase the required reserve, altering the volume of loans and therefore adjusting the money supply. The U.S. Federal Reserve rarely alters the reserve rate, preferring open market operations, which is buying and selling government-issued bonds, to implement their monetary policy. On the other hand, the People's Bank of China often alters the reserve ratio to combat inflation. Currently, our reserve ratio is 10%, and with our CPI of 2.7%. Also, the Federal Reserve discount rate is 0.75%, which is exceptionally low. meaning the Fed is trying to increase the money supply. So now it's an opportune time to get a loan.